I have information you need to hear before it becomes widely known. Sources closely tracking CME group activity are indicating that another margin hike on silver futures is being prepared. Not debated, not merely discussed, prepared. Internal paperwork is being finalized, timing is being coordinated, and one date keeps appearing across multiple independent reports. February 21st, 2026, just 11 days from now. If you are holding leveraged silver positions, trading futures, involved in options, or exposed in any way to the paper silver market, what I'm about to explain could protect your portfolio from serious damage. We already saw what happened on January 31st when the CME raised margins without warning. Silver collapsed 31% in a single day. Billions of dollars in leveraged positions were wiped out. Traders who had been profitable for months were destroyed in hours. Some lost more than their account balances. Some lost their homes. Some lost their life savings. And the traders who didn't see it coming, who believed they could ride out the volatility, were the ones who paid the highest price. I don't want that to happen to you. That's why I'm recording this now, before any announcement, before panic sets in, and before it's too late to act. Welcome back. If this is your first time here, subscribe immediately, because the information shared on this channel can be the difference between building wealth and losing everything. By the end of this video, you'll understand what a margin hike really is and why it matters, what happened during the January 31st margin increase and why it caused a crash, why the CME may be preparing another hike, the specific date and timing to watch, how to protect yourself from liquidation, and how some traders attempt to profit during these events. So let's start with the basics. What is a margin hike? In the futures market, you don't pay the full price for a contract. You put down a small deposit called a margin. This gives you leverage, amplifying both your gains and your losses. When the exchange, like the CME group, raises the margin requirement, it means traders have to put up more of their own money to keep their existing positions open. Think of it like a bank suddenly demanding a bigger down payment on a loan you already have. If you can't come up with the extra cash, which is called a margin call, your broker is forced to sell your position at the current market price to cover the difference. This is called a forced liquidation. Now, imagine this happening to thousands of traders all at once. What do you get? A massive wave of forced selling, which pushes the price down even further, triggering even more margin calls and more selling. It's a vicious cycle that can cause a market to spiral downwards incredibly fast. This is exactly what we witnessed on January 31st. So why would the CME do this again? Exchanges typically claim margin hikes are a tool to curb excessive volatility and reduce risk in the market. When a market gets too hot, with prices moving up very quickly, they step in to cool things down. By increasing the cost of speculation, they force some of the more leveraged players out of the market. Officially, it's about maintaining an orderly market. However, many critics argue that these hikes are often used strategically to halt strong rallies and protect the interests of large institutional players who may have massive short positions. If the price of silver keeps rising, these big shorts stand to lose billions. A margin hike is a powerful weapon to stop that from happening by creating an artificial sell-off. This brings us to the critical date, February 21st. The information I'm seeing suggests this is the target date for the announcement. It's not a coincidence. It's positioned to cause maximum impact. An announcement could come after market hours, leaving traders scrambling overnight to meet their margin calls before the market opens the next day. This creates immense pressure and panic. So, how do you protect yourself? The first and most important step is to assess your exposure. If you are heavily leveraged, you need to consider reducing your position size immediately. Don't wait for the announcement. Don't wait for the margin call. Acting now, while the market is still relatively calm, gives you control. You can choose to sell a portion of your position to free up cash, which reduces your risk of a forced liquidation. Remember, it is far better to voluntarily take a small profit or a manageable loss than to be forced out of your entire position at the worst possible price. Another strategy is to avoid futures altogether and focus on physical silver or unleveraged ETFs. While you won't get the same amplification on your gains, you also won't face the risk of a margin call wiping you out. Your position is yours, and no exchange can force you to sell it. For traders who want to stay in the game, you can look at using options to hedge your position. Buying put options can act as insurance against a sharp price drop. If the price of silver does collapse, the value of your put options will increase, offsetting some of the losses from your long futures positions. Now, some aggressive traders will actually try to profit from this. Knowing a margin hike could cause a sharp drop. They might initiate short positions just before the expected announcement. This is an extremely high-risk strategy, and I am not recommending it. If the margin hike doesn't happen, or if the market reacts differently, you could suffer significant losses. But it's important to understand all sides of the game. The bottom line is this. The risk of another margin-induced crash is very real. The date to watch is February 21st. Your best defense is to be proactive. Reduce your leverage, understand your risk, and have a plan in place. Don't be the one caught by surprise. The market doesn't care about your portfolio. You have to. Thanks for watching. Hit that subscribe button and stay safe out there.